Okay, so welcome back to the desk. We're going to push on now with video number 8, and we're going to look at our next driver in our endogenous analysis of the United States, and we're going to start looking at the M2 classic money supply in the US. Now, we briefly covered M2 in the foundation section earlier in the video series. We briefly skimmed over it, so if you need to go over that again before you push on here, feel free to do so. I'd encourage you to watch the videos over and over again to get a proper understanding of what's going on here, especially in this situation, because we're now going to dig actually very deep into a statistical analysis, and it's the same statistical approach that Chris Quill showed you earlier in the video series when analysing currency returns and the distribution of those currency returns. So if you recall, when we were analysing volatility. So we're going to take exactly the same approach as that, and we're going to start looking at the statistical distributions of US M2 money supply. So if you want to brush up on the actual process, I'd encourage you to go back and look at the currency returns distribution framework and how that is all worked out, because we're actually going to go very deep into this statistical analysis, and there's a lot of numbers and it can get quite complicated. But I assure you, if once you learn that process, if you just do this on a repeat basis in parrot fashion, you're going to actually pick this up very, very easily. Now, one thing to note before we move on to look at the M2 data, printing or money printing has been extremely topical, obviously, across the world in the last 5 years. And that's been because of quantitative easing policy. Now, if you recall earlier in the video series, we did go over QE briefly, and we did mention in the foundation section that QE is one of those last resort policies where classic monetary policies have failed to work, and central banks, the central authorities, resort to these extreme measures like quantitative easing when all classic monetary levers have failed. And this has been really typical over the last 5 years across the Western world and even in Asia. It's been really typical in terms of policy from central banks and central authorities because monetary levers, classic monetary levers, have not been working as well as they should be or compared to history. And quantitative easing programs have been pushed out across the world in response in order to stimulate inflation and growth after the financial crisis. So they're very, very typical across the world now in terms of policy, so quantitative easing. And the quantitative easing policies essentially for traders, portfolio managers, asset managers, professionals of media, everyone involved in the finance industry, what they've actually done is divert a lot of attention away from the classic monetary levers. But what we have to do when we're looking at our scorecards and building out our systematic process is that we have to do this very objectively and look at everything. And M2 is actually the classic plain vanilla way of printing money. And it's all publicly available data, all publicly available information, but the market in the last 5 years has obviously been very preoccupied with quantitative easing programs and this way of printing money, and that has basically diverted attention away from this. And I think what you're going to find when we go through this data is that it's actually very, very interesting to analyze the M2 data, and actually analyzing it on a weekly and monthly basis, and comparing it to GDP levels. because it is actually one of our main leading indicators in the United States, and it's the classic way of printing money. And this is something that professional traders, hedge fund managers, asset managers, and everyone in the finance industry who builds out systematic processes, this is something that everybody can't ignore. Money supply is absolutely crucial. So let's push on and we'll take a look at the data for US M2 money supply, and I'll see you on the computer screen.
Okay, so welcome back to the computer screen. What we're going to look at now is the money supply, so M2 money supply that we actually looked at earlier when we were going through the first part of the video series in Foundation. So we briefly skimmed over it when we were looking at injections and withdrawals from central authorities, so central banks. And the M2 money supply basically makes up the second driver on our overall scorecard. And it's a really important determining factor in our overall analysis. So what we're trying to do here is predict in the economy the value of a currency through inflationary and deflationary drivers. And the M2 money supply is very important. It literally is the supply of money coming from central authorities being injected into the economy or withdrawn from the economy. And as an endogenous driver, it's pretty straightforward theory that the more money that is supplied to an economy, then all things being equal, the more inflation there will be in the prices of goods and services, because the money is a medium of exchange and is used to acquire these goods and services. And obviously the case in the opposite stands as well. The less money that is supplied, the more deflationary this is. Now, on the gold standard and Bretton Woods, the money supply was grown at the same rate as the supply of gold. So the same rate as it took to mine and produce the gold, which backed paper money as collateral. And as we saw earlier when we were looking at Forex market infrastructure and studying central bank participation, paper money is now no longer backed by gold and is simply known as fiat money. Now what that means, as we saw earlier, is that the supply of money can just be increased or decreased as and when the central bank, and in this case the Federal Reserve in the US, sees fit. And basically the Fed increases or decreases the money supply, M2, by just increasing or decreasing banking reserves. And the way this mechanism works is that if they add to reserves, this, all things being equal, is supposed to flow down into the economy through the banking system and onto the street. So through the mechanism of increasing loans, and obviously vice versa, the opposite holds true. If reserves are decreased, then loans are decreased, and this mechanism means that less money is supplied into the system. Now basically adding to reserves is what we call the classic money printing mechanism. What it does is it basically allows the banks to multiply their deposits and increase the amount of money as defined by the M2 definition in circulation in the economy. And it's supposed to be done at a constant and predictable rate. Now, in the overall systematic process, we need to look at M2 as a leading indicator, even though it's coming from the right-hand side of our overall systematic process in idea generation. We need to see M2 as a leading indicator because the central authorities, in this case the Federal Reserve, is looking at the leading economic indicators, such as surveys as we looked at before, the central bank, the Fed, is looking at the leading indicators and printing money, so increasing or decreasing reserves, increasing or decreasing the money supply in response to these leading indicators. And these actions by the Federal Reserve affect the coincident drivers or indicators. So we just need to understand that overall flow in the idea generation process. So in the overall process, the money supply, M2, we have to put this down as a leading indicator. And as a leading indicator, that's great for us as traders because we can take all these things together, scorecard them in a systematic process in order to gauge inflation and deflation in the future and predict coincident drivers and indicators, and thus get views on the exchange rate or the value of the money in the economy. Now, M2, as we saw earlier, is the broadest and most important measure of the money supply. And it's used as an injection, so increasing reserves, and a withdrawal to slow down reserves in order to control inflation and therefore growth in the economy, and even to affect sometimes the value of a currency. And a country's exchange rate can definitely be affected by the central bank's policy on the rate of growth of the money supply. If you just think about this in basic terms, if there's a huge increase in the money supply and this generates high levels of inflation in the future, or is predicted to, then what happens is essentially the money stock that is already in the system, the money stock begins to lose its purchasing power. So it loses its value. So on a loosening policy, it's more than likely that as traders, in terms of predicting the future, we will seek to have a short currency bias in those circumstances. And the opposite also holds true, that if the money supply dries up or injections decrease significantly, this is deflationary because the money stock that's already in the system, because prices are going lower, and this is deflationary or increasing at a lower rate. This means that the money stock that's currently in the system increases in value because now that money can buy more. And in these circumstances, we are looking at doing the opposite as traders. If we predict deflation in the future, as indicated by slowdowns in the money supply, we are seeking to potentially have a long currency bias because now the money stock is becoming more valuable. And in a dirty or managed float system like the United States, the money supply can be used by the central bank to manipulate the exchange rate higher or lower. Now, why would they do that? Well, if the dollar moves significantly higher or lower and has extreme moves on the international markets, the value of the currency can be affected by central banks with the intention of controlling internal inflation or deflation, and also with the intention of affecting balance of payments, so international trade through imports and exports. So it's a very, very important indicator for us. And as mentioned previously, M2 money supply is definitely classified as a leading indicator. So leading and affecting the economy or predicting the future. So where do we get these stats and what do they all mean? Well, they are released on a weekly basis by the Fed, and the data goes back to November 1980. So this is all the publicly available data, and it's available on the Federal Reserve Bank of St. Louis website. So if you just go to this link here, you will find all of the data, and you can literally hit the button and download it. Now, what's quite interesting is that the M2 data tends not to be immediately market sensitive. And this is because the money supply, as you would expect, grows at a pretty steady pace. And this is evidenced by the historical data. However, this doesn't mean that we shouldn't try to understand it and analyze it on a regular basis. So what we do is we analyze the data all the way back to 1980. And remember, this is weekly data, so there's quite a lot of cases. We analyze the data looking at the long-term growth rate of the M2 money supply. And then we look at the outliers. So we analyze the trends and when the trend is broken. Now we're going to look into this a little bit deeper with an example from the endogenous driver analysis spreadsheet. So if you have been to the download section, downloaded that, let's go over to the spreadsheet here. We'll move out of the permits section, and we'll be in the M2 section in a second, but let's have a look in the sources tab. And you can see here in our M2 money supply area, in our row here, row 12, we have the link source to St. Louis Fed, where we can download all the data. And if you just go to that link, you can just click on download data, and everything, all the data will pop up. And you can see here, we just have two columns. We have the date and the value of the money supply. And then we're going to be working out the changes. And we get all the data coming all the way up to present day. Now, if we just minimize that and go back over to our endogenous analysis, we'll click into M2 here, and you'll see how we have all the data here, and we have a pretty in-depth analysis of the money supply. So let's go through the columns here, what we've got. First of all, we have the date by weeks. We have the value of the money supply and the change on a weekly basis in the money supply. We also have the percentage change in GDP, and that is real GDP on a quarterly basis, and that is worked out as an annualized rate. And this data is also downloaded from the St. Louis Fed. We then have the percentage change in the weekly money supply. So in this cell here, we can see that this is simply the cell B11 minus B10 divided by B10. So this tells us the percentage rate of change in the money supply. And then here we're multiplying E11, so this result, by 52 weeks. Now what we've done here is we've done an analysis which is exactly the same as the analysis that we went through earlier with Chris Quill, where we work out the distribution of returns. So this method can not only be used for asset prices, as in working out the percentage returns or distribution of those percentage returns over various time periods and analyzing that data. This method can also be applied in broader economics to look at economic data and analyze economic data. And by taking the exact same approach, we do find some extremely interesting results. Now, this analysis is pretty detailed, Now, what you can do is obviously get the data yourself, learn that method that Chris taught you earlier in terms of working out the distribution of returns, and go through the process yourself. And this will be very, very good for you in terms of your overall learning, because once you know how to do this backwards, and you can do it on autopilot very easily, you'll be able to apply this to anything. So you'll be able to download economic data on any type of indicator and look for a distribution of returns, and look for trend, look for fundamental trend, look for normal trend, look for abnormal trend. And this is exactly the way professional traders do it. We apply these methods to really understand what is going on behind the numbers. So what do we have here? Let's have a look at some of the basic overall workings out, calculations and results. So as you did with Chris earlier, we work out our intervals, and you can see there's a lot of intervals here. So we're going from plus 50 all the way to minus 50 on our interval scale. We have our descriptive statistics as well over here. We also work out our mean scores, so our averages over here. And we also have our comparison of this data in terms of the distribution relative to the bounds of a normal distribution. And then over to the right here, we also have our scorecard, which we will come to later. So you can go through these numbers in your own time. We will go through them in a second when we go back to the presentation, but you can reverse engineer this spreadsheet, dig into detail, figure out what's going on, and it's exactly the same process as Chris went through earlier, but it's a bit more larger in terms of the data set, intervals, and also in terms of interpretation. It's obviously different because we're not looking at the returns of a currency pair. We're looking at the change in M2 money supply, and we're trying to interpret what's normal and what's not normal. So it's the same method, but just different application and different interpretation. And you can see here the histogram of the weekly money supply. And you can see here the 0 point in the distribution. And you can see that most cases pictorially are obviously positive. And this is pretty normal. This is a pretty normal situation. We're going to discover that it's pretty normal that the money supply is constantly increasing, and that is the majority of cases. We see that we have a weekly average of 5.84% increase in the weekly money supply. But when we look at this as a 5.84%, this is an annualized number. So you can see here the weekly percentage increases and decreases are actually very, very small. We multiply these by 52 to get the constant annualized growth rate. So if we were applying the same growth rate every single week consistently moving forward, we can see that the long-term average growth rate is just under 6%. So it's always good to get the basic numbers right and understand the behavior, the normal behavior of this economic indicator. And what we've discovered almost straight away is that the normal behavior of M2 money supply is to see a constant annualized growth rate of just below 6%. Now, what we're trying to figure out here is what's normal, what's not normal. And it's pretty obvious that negative is not normal. So decreases in the annualized growth rate of the weekly money supply. and large increases. So decreases in general and large increases. So what we have to do is actually go through the numbers and start seeing exactly what really applies here. So let's go through all of these numbers now, and building from the overall broader picture, we can see that when we just look at the nominal money supply, so we're looking at the numbers here of the money supply, so the overall money supply in billions of dollars, when we look at this, we can see that the trend is pretty constant. So we've calculated an average here. This chart is available in the endogenous analysis spreadsheet and inside the M2 tab, inside the M2 file. We've worked out an average here, and we can see that the money supply trend is very, very constant. And this is going all the way back from 1980 up to present day. And we notice from this overall average trend that since the financial crisis in 2007-8, the increase in the money supply is well above trend. So we have to just understand the bigger, broader picture. This chart is also available in the M2 tab. We realized this earlier when we looked at the average. The long-term weekly annualized rate of growth of the M2 money supply is around the 6% mark. And when we correlate this to GDP, it's correlated to around 1%. So the money supply increasing by 6% on an annualized basis is basically correlated to or contributing to a 1% GDP growth rate. And since the 2008 financial crisis, the percentage of the money supply actually hasn't increased. So if we look back at the billions of dollars numbers, the nominal numbers have increased, but actually the constant annualized weekly growth rate, the percentage move on a weekly annualized rate hasn't really materially increased. And the average rate of annualized growth has stayed constant at around 5 to 6%. So how do you get the nominal number increasing well above trend, but the percentage number on a weekly basis continuing to stay around long-term average? Well, it's pretty straightforward. There's obviously a couple of things going on there. If we go back to the previous screen. Firstly, after the financial crisis, there was obviously a big deflationary period during and coming out of the financial crisis. And the Federal Reserve can actually do 1 or 2 huge weeks. So instead of having a multiple week increase in the money supply, what they could have done, and this is just looking at the numbers objectively, nominal versus percentage return, what they could have done, or probably did, was actually just have a few weeks where they increased the money supply at a huge annualized growth rate. And that wouldn't affect the overall average if then afterwards there were lots and lots and lots of weeks where the money supply was at or below, just below average weekly annualized percentage increase. Which brings us on to the second thing they could do is, relative to history, just have in the period 2007-8 to 2015 current day, have more average weeks than in the past. So basically have more weeks around 5-6% than in the past. And if you do those two things, you can actually have a percentage increase in the weekly annualized rate that stays the same, but the nominal number accelerates or goes up. Now let's have a look at these statistics in a bit more detail. So as you've seen, we've taken a distribution of weekly annualized rates, and we're trying to discover the behavioral nuances of the money supply. The first thing we've discovered is that there's a lot more positive data points than negative data points. So more money supply growth than contraction. And that's really to be expected. You know, this is what you're doing here is you're actually looking at how capitalism works, how Western world economies have worked for a very, very long time. Having a constant increase in the money supply is basically one of the main fuels to a capitalist system. So overall, we do keep coming back to this, that the PFTM video series is an overall lesson in macroeconomics and international trade. Well, this is what we're talking about again here. You're learning some pretty straightforward economics here and how capitalist economies work. These weekly increases, the positive data points, which are very normal to a capitalist system, basically outpace the negatives by a factor of just over 3 to 1, so 3.16 to 1. The average growth rate of the weekly annualized number in M2 money supply is confirmed to be 5.84%. And when we look at the average positive week, the average positive week is plus 9.4%, and the average contractionary week annualized is minus 5.38%. So when we actually probability adjust this, so we look at the frequency of up days and the of up weeks, and we look at the frequency of down weeks, the probability adjusted annualized weekly M2 growth is 7.13% on average for the up weeks and minus 1.28% on average for the down weeks. So we're starting to get an appreciation here of how weekly M2 money supply behaves historically on a normal basis. So all of these numbers here that we're looking at are what is considered to be normal or within the bounds of normality. So we're looking at fairly predictable normal behavior here. We're asking ourselves the question, what happens normally? So we have our answers. We have the weekly average, which is a positive of around 6%. And we look at the average positive move. So in a positive week, the average move is 9.41%. In a negative week, the average move is minus 5.38%. And remember, these are all annualized weekly moves. The frequency of up days is 1,356, which is 75% of the time. And the frequency of negative weeks is 23.9%. And obviously we do have some zero values as well. But we look at the probability adjusted move on a weekly basis, and on an average positive week, the probability adjusted week move is plus 7.13%. And the average negative week on a probability adjusted basis is minus 1.28%. So everything that you're looking at here is within the bounds of what would be considered to be a normal situation overall, and if we had a positive week or a negative week. So we're looking at what we consider to be normal situations. Now what happens if we start looking at the abnormal data? So we need to start looking at this from a standard deviation analysis and perspective. And what we find, if we do this exercise in exactly the same way as Chris taught you earlier when looking at currency returns, what we find is that our standard deviation, so our one standard deviation move, is 10.46%. So that is what we consider to be within the bounds of a normal weekly annualized increase in the M2 money supply. And what we need to do is look at both the positives and the negatives from a standard deviation perspective. And we look at a 1 standard deviation move in both the upper and the lower bound of the data. And a 1 standard deviation move in the upper bound is 16.31%, and in the lower bound, minus 4.62%. And we can see from looking at the data, when we look at our frequencies, 1400, so 1446 weeks or cases as part of our count fall within 1 standard deviation. And this is 80% of times. When we look at this relative to a normal distribution, 1 standard deviation is 68.2% of cases. So what does this mean for our data? Well, it basically means that M2 injections and withdrawals in the United States are very peaky, and they have few but much larger tails than a normal distribution. So what this means is that there's a very normalized rate of weekly growth on an annualized basis in the United States with M2. And then occasionally there's huge increases and huge decreases. And it means that the values in between, so the values in between this normal area and the extreme positive and extreme negative areas, these values in between are very few when compared to a normal distribution. So in terms of interpretation, this fits what we know in terms of how central authorities behave. In the vast majority of cases, central authorities, when it comes to M2 money supply, will actually increase or behave in terms of increasing the money supply at a very predictable rate. And then occasionally, when we have shocks, so economic shocks, both negative and positive, central authorities react and they create extreme moves in the money supply. And what they're doing here is obviously reactionary to what they see as a signal from the economy. So this data actually is behaving in a way, when we interpret it in a way that is very consistent with the way we view the world. So now what we're beginning to appreciate here from the data is what constitutes overall normal behavior and what constitutes overall abnormal behavior when we interpret this data set correctly. Now, given that 1 standard deviation of M2 annualized growth, so 80% of the times, is falling within these bounds, this basically means that 20% of the time there are what we can call shocks, and they're shocks because they're in the minority of cases. So this is going to be constituting a significant slowdown in money supply or a significant increase in money supply. And that is what we're going to focus on here, because this potentially causes an increase in currency volatility and a change in trend. So for example, when the Fed responds to overheating, so excessive inflation in the economy, how do they react? They're reacting by decreasing bank reserves below a normal pace, which causes deflation and causes the value of their currency to increase. And the opposite holds, as we know. If the Fed is responding to contraction, so deflation in the economy, then they're looking to increase bank reserves at above a normal pace, creating inflation and thus potentially decreasing the value of the US dollar. And remember, we're looking at this always from an endogenous perspective. We're not looking at the US dollar compared to any other currency. We're trying to get an absolute measure of what we think of the US dollar, not comparing it to anything else. So remember, when we talk about buying the dollar by selling another currency, well, we'd have to have a view on that other currency. That's what we do later in the exogenous analysis. Here, we're looking in absolute terms and trying to determine inflationary or deflationary conditions on a standalone basis for the US dollar. We're looking at now M2 money supply, how that behaves and how we can use it to predict inflationary and deflationary conditions from the US economy and thus affecting the value of the US dollar. And similar to the way in which we analyzed surveys in the first section of idea generation, we scorecard money supply in a similar way. And we do this by looking, as we have done already from the data, we scorecard by looking at the data and distinguishing between what's normal and what's extreme. And we do this by looking at the one standard deviation or normal bounds of increases and decreases. And when we're looking on our scale here, a normal situation in the negative is around -5, -10. And in the positive section of the data, it's around +10, +15. So these are the one standard deviation normal moves that we looked at earlier, where we have 80% of occurrences. Now, when we look at the deflationary area over here, so when the money supply is decreasing, we tend to have a long bias towards the currency because a decreasing money supply is deflationary or predicting future deflation. And within the normal bounds, this is in the significant minority. So we actually scorecard quite highly here. So when M2 money supply is being slowed down by the Federal Reserve, we tend to have a long currency bias because the slowdown is an occurrence of tighter monetary policy. And on the extreme situation, so if the Fed has been decreasing money supply on a weekly annualized basis by a large amount, it's a prediction that it's not going to be the case for a very long time because normality is to loosen. So on the extreme negatives, we tend to have a short currency bias predicting future inflation. And overall, we just have to remember in context that the central bank, the Fed, is reacting to indicators that they see in the economy as potential deflationary threats. And if they go too far in decreasing money supply, they're probably not going to be here for very long. So we need to look to position ourselves with a short bias to the currency because it's more than likely that they're going to jump into the positive territory very quickly. And that's what we come on to next. So when we're looking at M2 weekly annualized money supply increasing, we tend to have a short currency bias. So within the normal bands here, a short currency bias because higher growth is usually the occurrence of loose monetary policy. And as you can see, we have our GDP scale here. Higher growth is basically tantamount to a loosening monetary policy. As we looked at earlier, this is just within the normal bounds how a normal capitalist system works. We tend to have the short currency bias because we're predicting normal rates of inflation. And on extremes, if the increases are large in M2 money supply, our conviction drops, and we may even begin at these extreme moves to predict the negative move, and we switch potentially on very extreme moves to a deflationary bias or long bias. So you can see overall how this picture works in terms of scorecarding. It's quite similar to surveys. Okay, so let's look at this in a bit more detail and try to cement what we've discovered here and how we scorecard everything. Basically, the closer we get to extreme contraction in M2 money supply, there's obviously a much higher likelihood of a future loosening monetary policy, so an M2 increase. And the closer we get to extreme increases in the M2 money supply, the higher the likelihood of future tightening or normalizing, so going back to the normal level in terms of M2 growth, unless there's a crisis, in which case they'll just keep printing money for the foreseeable future at very high rates. And this is why we have a neutral bias here, where it's completely normal to print at 5-6%, and then a short bias all the way up, the positive side of our M2 scale. M2, as we've seen, spends most of its time growing, so 75% of the time, and at a predictable and normalized rate of 1 to 10%, which is why here we scorecard quite low, so 0 and +4 on the overall scale. So in terms of conviction terms on our short bias, when we have normal situations, we score very low. And when M2 supply is negative, so 25% of the time, so 0 or negative, it's more likely that the Fed is reacting to some sort of overheating in the economy. So they're trying to slightly deflate. And this isn't a common occurrence, which is why we score quite highly for a long currency bias in deflationary periods relative to the normal situation in the positive normal range. So when we're scoring for the short currency bias or inflationary periods. Now, one interesting point here is if you count all of the scorecard occurrences, there's 15 in total, and 11 of them are inflationary short currency bias, and 3 are deflationary long currency bias. 1 is neutral. And the scores are extreme, or more extreme, so higher in total for the short currency bias. So we have a lot more, and they tend to be higher on extremes. So these situations here versus the long currency bias. And throughout history, what you will see if you actually go through and analyze the data, and we'll do that in a second, so we can learn a bit more what's going on behind these numbers. Throughout history, what you're going to see is extreme positive M2 prints when economic crises occur. And obviously that's designed to counter deflationary conditions by causing significant inflationary pressures in the economy. And in the opposite, we have a fall in conviction when significant inflationary pressures are predicted. And that's because when inflation gets out of control, so when the Fed actually prints extremely aggressively at the annualized rate, that's usually in response to a crisis, our conviction for a short currency bias falls because it's more than likely that this number is going to drop very, very soon. And in these situations, we don't know how long these crises are going to occur because they're usually unique. So we don't scorecard here for a long currency bias because it's extremely inflationary. We're predicting extreme inflation, and then we have to be prepared to potentially move to the long currency bias if this drops significantly and doesn't have a huge impact on the economy. So we basically scorecard in a lower score at the very, very extremes, and scorecard low within the normal bounds. And when we're somewhere in between, we're scorecarding quite high in terms of inflationary bias. Now, what you have to remember and keep in the back of your mind here all the time is that this is an endogenous analysis. So I think it's good to do a little recap here, because we have scorecarded now surveys and M2 money supply. This is an endogenous analysis, and this sliding scale scorecard process that we're going through is obviously not a rules-based system. It's a best practices guide, and it's also adaptable. And it needs to be like this in terms of a systematic process, because when it comes to GDP growth, jobs, inflation and deflation, and with those things being a concern, it needs to be an adaptable system, in a sense that the variables of leading indicators and also of the coincident indicators can obviously change, and policymaker behavior can change over time. What we're doing here is an endogenous analysis, not comparing this country to anything else in the world or this currency to anything else in the world. What we're doing is looking at it in absolution and isolation. And we're also trying to go through a systematic process which is objective. So it creates objectivity. So think of this in the opposite, in terms of getting a view on the US dollar. If you simply just looked at a chart of the US dollar against another currency, you're not really digging and finding out objectively what the fundamental trend and behavior is behind the variables of the US economy that potentially drive the value of the US dollar. So really what you're doing is trading blind. You're taking views on the value of a currency relative to another without knowing what drives it and how those drivers behave and what those drivers are saying now. So remember, this is an endogenous analysis that's systematic, and we have to go through a systematic process to maintain objectivity. So it's not a rules-based system, it's a best practices guide. A rules-based system is something that retail traders look for all the time, where if a certain level, if an indicator comes out at a certain level, it means buy or sell. That's not the case in the systematic process. We look at the points where in history economic drivers predict certain things, and we look at the majority of cases. So, and we try to scorecard on a multitude of factors. And we believe if we do that and scorecard on a multitude of factors, we will get to a result which is objective and kind of tells us what we should be thinking and what we should be doing. So remember, it's an endogenous analysis, not a rules-based system, and it's a best practices guide. Okay, now back to our analysis of M2 money supply. Let's have a look at the spreadsheet and how we actually go about scorecarding this. So if we go to the endogenous driver analysis spreadsheet back into the M2 tab, one of the sensible approaches we can actually take is to look at an average of the last 12 weeks. So if we scroll down, we can see, if we highlight the cells here, we can look at the last 12 weeks, and we have the annualized rate here. And if we just add these up and divide by 12, we get an annualized average rate of 9.23 0.375% weekly annualized percentage increase in the money supply. So what do we know about that number? Well, what we know about that number is that it's within the normal bounds of our 1 standard deviation move. And that's pretty much a typical move on an annualized increase. So it seems on the surface that the Fed in the last 12 weeks has actually been behaving quite normally. But we have to look a little bit deeper because there's some numbers here that are extremely positive. So we have a plus 32.5% and a plus 32% weekly increase on an annualized basis in the M2 money supply. So what does this mean? Well, let's go back to the presentation. So we take the last 12 weeks and work out this average level. The average level in the last 12 weeks of the annualized weekly money supply. By doing so, if you do this every week, what you're actually doing is continually working out a rolling quarterly number. Now, we did notice that we got the 9.2375% normal situation on this rolling 12-week basis. But we did notice that there were some outliers here. And we saw the outliers here as 32%, around 32% weekly annualized percentage increase. And these occurred in the first week of January and last week of January because the data is reported the week after. So basically, these numbers here, we need to do a little bit more digging to find out what these type of moves in terms of their magnitude historically can be associated with, or if there's any link between these types of moves and moves of this magnitude in the history of the M2 money supply. But on a purely scorecard basis, the average is 9.2375%, which is mildly inflationary on our scale and is close to a 1 standard deviation move. And it's normality. So we basically scorecard this as something that's around a 0 on our scorecard. And that's what we'll be doing later when we look at scorecards after we've been through the entire endogenous analysis. But what I want to do now, before we finish up analyzing the M2 money supply trend, what I want to do now is show you how you can actually look at this data and interpret the extreme moves, because I think that's quite important. If we go back to the endogenous sheet and we just tidy this up here, what you can actually do is analyze the data by filtering for extreme values. And if we add filters here to each of our columns, we can then look, as we did earlier in Chris's analysis, to filter our data by extreme positive and extreme negative moves. So if we look for values greater than our average or even further out in the data, we can find out and compare the data recently with data in the past and see if there's any link with these extreme moves to similar data in the past. So we know that our moves were 32%, so we can filter for a value that's greater than 30%. So we put in here 0.30, and that brings up a table here of times in the past when there's been a weekly annualized percentage increase that's greater than 30%. And we see that there's not much data. There's not that many occurrences. And we can see as well that our weekly average has changed whereby whenever this has happened, the actual average weekly increase has been 48% on an annualized basis. And if we start to think about this and interpret this properly, we start to look at the dates. Now, excluding the ones recently, if we look at the dates here in the past, what we're finding is actually that there is a very high occurrence between weekly increases on an annualized basis above 30% and economic crises in the past. So this is actually quite strange behavior. And if we go back to the presentation here, if we filter for these positive outliers above 30%, we see that there's a big correlation between this behavior in the M2 money supply and big deflationary threats. So periods where the Fed is reacting to big deflationary threats, so economic crises, and trying to inflate and expand in the extreme case. So this is quite interesting. So if we look at all of the numbers here, if we go back in time, we've got situations like the August 2011, and that was recently after the ratings agency S&P downgraded the United States credit rating. We also have the week where the Bernie Madoff hedge fund blew up in December. We also have Lehman Brothers week in September 2008. We have the expansionary period coming out of the early deflationary period, the deflationary period of the early noughties after the tech bubble burst in the stock market, and after September the 11th. We also have the week after September the 11th. We also have a period which is around the Asian financial crisis. And we also have the period after the 87 stock market crash. So this is actually very, very interesting to look at these things. And this is an example of how you would actually just interpret the data. You can filter all of these values. And when you look at this in terms of the dollar in absolute terms, on an absolute scale, it's interesting that, you know, at this period in time, these things are happening, and the perception in the world is that the dollar is a very safe place to be. And this is at the time that we're basically going through this video course. You can get this table as well in terms of the recessionary periods. So this is when recessions occur in the United States. So more than 2 negative quarters of GDP growth post-war. So post-World War II, all the negative GDP or recessionary periods in the United States, and the length of these recessions until positive GDP growth came back. We get an average of 11 months. So recessionary periods tend to last on average 11 months in the US. So that table is available in the endogenous driver analysis spreadsheet, and on all of your scorecard metrics. So on all of the drivers within the scorecard, you can just filter and compare the data and try to interpret this data correctly. Now, the obvious question when we're filtering this data for positive outliers, so the extreme positive outliers, the obvious question is, what about the extreme negative outliers? Well, let's have a look at them. What we've done here with the data is actually filtered for outliers less than 20% in M2 growth. And there's actually significant overlaps with deflationary threats from the previous slide. So after big percentage increases in the money supply, there obviously tends to be big percentage falls. So we have to look at the cases throughout history that basically aren't accompanied by big moves higher. So we want to look at the negative numbers that aren't accompanied with big moves higher. And the most recent ones are March 2009, which was extremely deflationary, and that was basically the bottom of the stock market. And it gave a very, very strong short currency bias signal. And if you go back to our scorecard, it begins to all add up now and make sense that on extreme deflationary moves that aren't accompanied with big percentage increases beforehand, these extreme negative moves in weekly annualized money supply, we're predicting that very, very soon there's going to be increases in the M2 money supply. And the other one was in Jan 2010, and this was just months before the quantitative easing program was officially announced by the Federal Reserve. So you can see that when you strip out the big negative moves that are associated with the big positive moves, so the magnitude of a big percentage move followed by a big percentage down move because of a natural cause effect on the numbers, when you strip these out, what you're actually left with is cases in history where the Fed has allowed the money supply to go lower and then followed it with big increases in increasing the money supply. And of course, do bear in mind, in the bigger picture, what we're trying to do here is not spoon feed you. We're trying to provide you with a systematic process where that you can engage by yourself and do this without relying on anybody else for information or views on what to do in the Forex markets. So these are basically examples of how you would filter and interpret the data. And you can repeat this process and go through all scorecards and all economic data throughout the video series in the various downloadable spreadsheets and start really learning how to apply these processes yourself. What we want to see is people taking this information, learning how to do the processes, and learning how to filter and interpret all of the data so they really do understand how macroeconomics works, instead of relying on us or somebody else to spoon feed them with the latest economic number and tell them whether it's good or bad and whether they should buy or sell. That's not how a professional trader approaches the markets. The way a professional trader approaches the markets is by doing what you're looking at here. And this is the best way to teach you how to do it, to provide you with the process, examples of how to do it, so you can go out on your own and do it yourself forever without having to rely on anybody. Okay, so that brings us to the end of M2 money supply. Let's go back to the trading desk for a quick recap.
Okay, so welcome back to the trading desk. What we saw there, we looked at the M2 Classic money supply. And obviously we went into quite a lot of detail in terms of our statistical analysis. But I can assure you, it is exactly the same approach as we took with Chris Quill, teaching you how to do currency return distributions earlier on in the video series. And if you just apply this approach and do it over and over and over again, practicing applying it to various currency crosses, currency pairs, and applying it to economic data. If you keep practicing it, it's going to become second nature to you. So it's obviously quite in depth and can get a little bit complicated, especially when we move on to interpretation. But if you do keep practicing it, you will get better. So just stick at it. Make sure that when you're doing it, you're going through every level. and also just making sure that the numbers are right as you're going through it, because when you get to interpretation, you never want to be in a situation where things are just all over the place and very confusing. So just stick at it and practice. Now, the M2 money supply, it's very easy to forget that this is the classic definition of money supply because of everything that's going on in the world right now with quantitative easing. It seems to have diverted attention away from the classic monetary levers, and M2 money supply is a classic monetary lever, and it obviously has a huge impact on economies, and the economy we're looking at here is the United States. The classic M2 money supply obviously has a huge impact on inflation and deflation, and therefore our economic outlook and also our views on the US dollar. And the way we went about analysing this data, if you recall, when we were on the computer screen, was actually looking at what is normal. And it's very, very normal in a capitalist system like the United States. It's a classic economic situation where the increase in money supply tends to run at a very constant rate. That's what money supply is supposed to do. And historically, that's what occurred when currencies were pegged to gold in systems like the gold standard and Bretton Woods. And the normal situation, when we look at the data, came in at around 5.5%, 6%. And that's an increase of money supply weekly when we annualize the number. So we looked at normality and we looked at what is abnormal in order to gauge inflation and deflation in terms of direction, and also the magnitude and conviction that we have. And we came up with our scorecard, which was actually extremely similar to surveys. And M2 money supply and surveys taken together really are genuinely good leading indicators for telling us what is going to happen in the future to an economy in terms of growth, jobs, inflation, and therefore the value that we have or put on in terms of the currency of the country. Now we're looking at everything in absolute terms here again. So the endogenous analysis. So we're not looking at other countries, we're just looking at what we believe are the drivers that are leading to the value of the currency in its entirety. Is the currency becoming less valuable? Is the currency becoming more valuable? And we're going to continue to do this and continue to roll out our endogenous process in order to further scorecard and get a much better gauge on what we believe our value of the US dollar to be, whether it's increasing or decreasing. So let's continue to do that and move on to the next video where we're going to look at our next driver, our next fundamental driver, which is interest rates. So I'll see you on the other side in video number 9.